Assets generally refer to the valuable things owned by an individual, company, or organization. These valuable things can be tangible or intangible. Assets can be categorized into two main types: financial assets and tangible assets. Financial assets: cash and cash equivalents, liquid assets such as bank accounts, cash on hand, and checks. Accounts receivable: amounts owed to the company by its customers due to credit sales. Securities: financial instruments like stocks, bonds, and other investment tools. Tangible assets: real estate. Immovable assets like land, buildings, residential properties, etc. Machinery and equipment: physical assets used in production, office equipment, etc. Vehicles: portable assets owned by the company, including cars, trucks, airplanes, etc. Assets are a crucial measure used to determine the value and financial position of an organization. Asset value represents the total worth of the assets owned by a company and is typically reported on the balance sheet. The balance sheet is a financial statement that displays an organization's assets, liabilities, and equity. Assets are analyzed to assess a company's liquidity, profitability, and overall financial health. Liability represents the financial commitments of a company or individual that involve the obligation to make specific payments in the future. These commitments are typically settled over a specified period. Liabilities are a crucial metric for assessing the financial condition of both companies and individuals. Here is more detailed information regarding liabilities. Categories: short-term liabilities. Debts that need to be repaid within 1 year or less. Examples include trade credits, short-term borrowings, and overdue invoices. Long-term liabilities: debts with a repayment period longer than 1 year. This category usually includes long-term loans, bonds, and debt instruments. Financial obligations: credit debts. Loans obtained from banks or financial institutions. Bonds: long-term debt instruments issued by companies. Mortgages: debt secured by real estate assets. Issued stocks: equity instruments issued by a company, representing ownership but not as a liability. Financial analysis and debt ratios. Debt ratio indicates the proportion of debt to total assets. A higher debt ratio may increase a company's financial risk. Interest coverage ratio reflects the company's ability to cover interest payments with its income. Risk and financial health. Liabilities can assist companies in obtaining capital for growth and financing projects, but may also increase financial risk. Effective liability management can help companies maintain financial health by ensuring timely payments. Liabilities are a vital element for understanding, managing, and evaluating the financial status of companies and individuals. Financial statements provide detailed information about these liabilities and their payment processes. Equity represents the value owned by the owner of an asset and is a term in financial statements that indicates the difference between assets and liabilities. In companies, equity typically includes both stocks and the company's profit. Equity signifies the net value of ownership belonging to the owner of an asset. Here is more detailed information about equity. Stocks. Companies generate equity through stocks. Stocks represent ownership in a company and grant specific rights to owners, such as the right to receive dividends and voting rights. Stocks are usually distributed among the owners of a company, shareholders, or stockholders. Reserves and profits. Companies can increase their equity by retaining a portion of their profits within the company. This allows the company to accumulate funds for financing future investments. Profits are often allocated into general reserves, legal reserves, or specific reserves. Equity financing. Companies can issue stocks to increase their equity. This can help the company obtain capital for new investments or reduce existing debts. Equity financing can enhance the financial flexibility of a company compared to debt financing, as shareholders are not obligated to predetermined commitments like interest payments. Cost and risk. Equity does not represent a fixed cost for a company because stockholders do not have a predetermined commitment to pay interest or repay. However, while shareholders receive dividends, those with debts must fulfill interest payments. Therefore, equity financing can increase the shares of shareholders as the company's profitability grows, while those with debt obligations must sustain their interest commitments. Equity is considered an indicator of the owner's wealth for an asset. Represented in the balance sheet as the difference between the total assets and total liabilities, equity expresses a company's net worth. Equity can increase alongside a company's growth and profitability.